I've got 5 charts on my radar that can produce some very high quality trading opportunities over the next several days. And of course, we'll be talking about what happened with the yen and more importantly, the follow-up that may be coming this week. We're going to start here on the euro dollar, and the euro dollar, even with the yen stuff going on, was probably the most surprising pair for me coming into the week. We had an interest rate decision on Wednesday where there was no expected rate hike to come, but there was the expectation that we would see 2 FOMC members dissent and vote for a rate hike. And surprise, surprise, we saw 3. Now, thinking about how the market should react, more or a surprise in the positive direction for a rate hike, a hawkish surprise, you would think would cause dollar strength, but we actually saw the opposite. And if you're wondering why that was, it was mainly due to the press conference. Despite the hawkish vote, there was still kind of a dovish type of tone in the press conference as Warsh tried to say things without saying anything in the way that he typically does. So we actually saw a lot of dollar weakness coming out of that event. That dollar weakness, along with some other stuff that happened later on in the yen, has pushed the euro dollar up over the past few days, and it is pushing it right up into the potential decompletion of what's called an advanced pattern formation. This one specifically is going to be a bat pattern, and it is a 4 or 5, hopefully 5 if it works out correctly, point move in the market. The first move is going to be called an anchor or an impulse leg. And this is pretty much a trending type of leg. It's a direct move, in this case, a swing high to swing low like that. Our second leg is going to be a retracement from that leg, and I'll draw on the Fibonacci's later to confirm what we need to confirm for the pattern. Our third leg is going to be a failed extension, right? So in a normal trend, we would extend down, breaking these lows and continuing to the low side. But this one, we don't actually extend down. And then that fourth move is a move back up towards the start of this whole pattern. And how we understand what pattern we're looking at is by what Fibonacci levels are hit. So as I grab my Fibonacci retracement tool from up here, I want to start off by dragging it from the initial swing high, the X leg, to the initial swing low, the A leg, and I want to see what level this B leg comes to. And this is going to come to the 50%, meaning that I'm going to alert for a bat pattern. Now, the bat pattern is pretty simple. I don't need to bring on any other fibs or anything like that. I just know the bat pattern is complete once price action, or if price action gets to this 886 Fibonacci retracement level. So all in all, it looks something like this. Swing high to swing low, X to A, first retracement, A to B, failed extension, B to C, and then a decompletion right up here at the 886. If you're an aggressive trader, you're going to have a limit order right at that 886. If you're a more conservative trader, then you can look for reasons for entry once price action enters that zone. And as long as we stay within that zone, meaning we don't break this X leg, this is still going to be a valid pattern. And the cool thing about that is that because this X leg is what invalidates the pattern, our stop loss just needs to go above that X leg. And you can see that's going to be pretty close to our entry, which means we'll have a pretty good risk reward in this trade. So euro dollar, if we can continue up a little bit higher, right near this 116 even handle number, we're going to have a bearish bat pattern. And that fifth move that we're hoping for is a retracement from that level back to the downside so that we can make some profit. Next up is going to be the pound New Zealand, and I'm going to try to bounce back and forth between more structure and classic chart patterns and advanced chart patterns. That way we don't kind of just crumple everything together. But we've got a classic price action pattern here in the form of a head and shoulders for some, or just a simple price action structure based trade. So I want to bring up the head and shoulders because that's been a popular subject here on our, not, I guess not here, but on our tier 1 trading platform, right? And it's going to look something like this. Our directional move going up is going to be our first move. This little retracement is going to end up being our left shoulder. This extension higher is going to be our head right here. Really good divergence up there. I'll show that in a little bit. Our move back down is going to be the move to our neckline. And then this little failed extension up, that's going to be our right shoulder for our head and shoulder pattern. Now, real quick, the thing I was talking about at the top, which is insignificant, but just curious to me because I'm a price action trader, is the fact that we got some very nice divergence, right? Price action continuing to put in higher highs, our RSI putting in lower highs, Has absolutely nothing to do with the trade, but I love price action. So when I see it, I get all googly eyed. Anyway, for our head and shoulders pattern, what we're looking for is one of two things, right? We're looking for either a violation of what's called the slanted neckline. That's going to be this dotted neckline right here, or the horizontal neckline, meaning taking the low of that shoulder or low of that neckline, excuse me, and dragging it straight from left to right. So you can see we're right at the edge right there. Now, as we go down to a lower time frame, right, we're going to see a similar situation here. We're going to see price action dive back down into these lows and then really put in a tight consolidation to end the week. So as we look at this lower time frame, whether you're seeing this as a head and shoulders pattern or not, what you're looking for is a violation of those levels, right? Either the slanted one or the horizontal one. And if we get that violation, and by violation, I mean a break and a close below that level, then we should expect that price is likely to continue lower. And if price is likely to continue lower, where are we likely to continue lower to? Well, the first level that stands out to me is going to be this little area right here. The second would be our full lows down there. Let's bring on some volume just to see if anything stands out within that mix. Yep, look at that. Right in this level around what, 227 even. We have our previous level of structure here. So it could be a nice selling opportunity either from here down to there. And if you're holding on for a secondary target or just want to shoot for bigger targets, you can look for a move all the way across back to these extreme lows over here. Heading over to the Dixie next, and this is going to look familiar because the Dixie is essentially an upside down version of the euro dollar. But this one does have a little bit of a warning on it, so I do want to measure this back in. But we'll make this one short and sweet. This is going to be a bat pattern. Again, it's almost identical to the euro dollar. So we're going to have our, where are we at here? Swing low to swing high this time, X to A. Our move back here being our A to B. Our failed extension here being our B to C. And then if we come down to that 886, which we got ever so close to, that's going to be the start of the completion zone, our decompletion, for our bullish bat pattern. Now, the warning I have, initially, when you look at this, you're saying, okay, Akil, look, we have been in a bullish trend. Price action broke and closed above these highs right here. This is a bullish bat pattern. We spoke about this with other pairs in the past. This is a perfect opportunity to catch a home run trade, meaning instead of trading it to traditional targets, which are counter trend based targets, meaning you want to be in and out of these type of patterns, this is a chance to hold on and shoot for the bigger move, pretty much like you're catching a trend continuation trade. And I would say you have the right idea, but we need more information. And for that more information, we need to zoom out and take a look at where price is actually at. And if we take a look at the highs of our pattern over here, boom, we're going to see that we came to a previous level of structure right here back in May 2025, but we did not violate it. And because we did not violate it, as we go back to our identify, predict, decide, execute, that's our 4-step process, we can't identify a violation of structure. Therefore, we can't predict a continuation to the upside. So if you're someone that's trying to use this as a quote unquote home run type of trade, just understand that you don't have the technicals to back you up. If this pattern, right, the A or the C leg broke and closed above this level, that would be a different story. It would be a big thumbs up. But unfortunately, we don't. And these are situations where sometimes your heart and your mind and your brain wants to do things, especially if you had like a bad week and you're trying to make up for missed profit, or if you had a great week and you're just feeling a little bit greedy. But you got to be a rules-based trader. You got to trade what you see on the charts, and that's what matters. And this is something called playing defense in trading. I actually have a video that I'm going to put out for you guys either Tuesday or Wednesday, looking at some past trading opportunities from last week's Trading Edge video and show you how playing defense would have kept you out of some really, really bad trading opportunities. So keep an eye out for that, again, Tuesday, Wednesday here on the YouTube channel. Because remember, good traders are great risk managers. And when we say risk management, it's not just talking about position sizing and trailing stops and stuff like that. Risk management also goes as far as knowing when to go for home runs, when to be conservative, and probably most importantly, when to read the warning signs that say, hey, although I like this trade, this is not a trade I should be in. And we'll dig into more details about that later next week. So yeah, Good trading opportunity here as a bat pattern, just not something I would hold on to for a continuation unless you've got a really strong underlying bullish fundamental bias about the dollar index and you don't really care about technicals. Next up is the New Zealand Canada, and you can tell this is a very consolidative pair. We like to bounce back and forth between support and resistance, which makes this trade kind of right in line with the personality of this pair. You can see price action has recently ran into a series of previous structure highs up here. We have a high from back in May, we have a high from a few weeks ago, and now we're testing that same level again. And as we go down to the 4 hour, right, we can see a pretty nice picture that has been painted in the form of a pin bar, right? A pin bar is going to be this candlestick right here where it has a long tail to the upside, meaning that price at one point pushed up to probe that level. But then we have a small body that closes to the downside, which means that selling pressure beat it back down and it wasn't really able to make any progress. Despite this candlestick being painted green, we look at this as a bearish signal. It's technically classified as a weak bullish candle, but that would be a bearish signal. Now, the hard part about this trading wise is the fact that we had a lot of consolidation before it. So if we look at this on a lower time frame, you're going to see that price rallied up here, and then we came down here, and then we came up, we came all the way down, we came up again before breaking it. And what that does is it really limits the opportunity for profit up in this level. So what we're gonna have to do here is really look at an alternative way of getting involved. Because again, although we had a lower low, lower close here to end the week, we actually ended the week by breaking and closing above a previous level of structure. And that's something that just doesn't fall into our counter trend rules. That would be a trend continuation signal technically, but then it also wouldn't be because we're right at structure, right? It's a whole thing. When you have rules, it makes sense. But there is still a way to get into this trade, but what it would mean is waiting for a rotation. And a rotation would mean that we need to take out the previous lows, right? So if we work backwards here, and this is our high, this is our low, this is our previous high, right? This is the level down here that would need to be taken out. So what I would look for in this situation if I want to get short is for price action to violate, break, and close below this level. I'm personally a pullback trader, so I like to look for a pullback that gives me a little bit of a cheaper price as well. And then once that pullback comes, wherever it comes in this zone, then look for that opportunity to short it back down to this midpoint here around, what is this, 8180s, around that area, or of course even a little bit lower, since this pair has shown the pattern of consolidating between different channels. Sorry, the voice is going on me. I'm trying to hold on. I got one more to show you, and I got that yen warning to talk about, then I'll get you guys out of here. Let's talk silver, and silver has been just holding these lows for the last few weeks now, and by a few weeks I mean, I guess, technically over a month now. So as we go down to the 4 hour chart, we're actually going to have two potential pattern formations forming here. One is going to be a Gartley pattern, a shallow Gartley pattern, and the other one is going to be a potential butterfly pattern, all depending on which of the X legs you choose. So we haven't spoken about Gartleys today, but it's very similar to the bat pattern. The only difference is we have a different Fibonacci requirement for that B leg and also a different D point. So the Gartley pattern is going to start off the same way as the bat. We're going to have an impulse or an anchor leg, a swing low to a swing high in this case. The second leg is going to be the same as the bat, as well as we're going to have a retracement. Now, the difference between the Gartley and the bat, that bat pattern needs to retrace to the 50%. The Gartley needs to retrace to the 618, so it's a little bit lower. We then have our failed extension once again. So instead of price kind of rallying up and continuing on, we retest our previous highs over here and we hold. And then with the Gartley pattern, we're looking for a move back down to our 127 extension, which should be right around here. So I'm going to take my Fibonacci extension tool from the high of my A to the low of my B and back up, and that's going to give me a 127 extension right here. So you can see the completion point for the Gartley is a little bit shallower than the bat pattern, but same thing. What that means is that if price action comes down to this zone, starting right here at the 127, and going all the way down to the X leg, this is the area in which we're looking to buy. And again, this comes in right at the bottom part of this, I don't even call it the sideways junk. Now, I can also see a trader making the case for a butterfly pattern as well if we take a different X leg. I'm going to leave the Gartley on just so you can see it. But if we took this X leg right here as our starting point and do the same thing, measure what I want to do is swing high to swing low. Yep, swing low to swing high, excuse me. Swing low to swing high. That is going to be our X to A. Everything else is going to be the same, right? Our first retracement is going to be here. I'm going to bring on a different color to make that less confusing for you guys. Let's do it like this. X to A to B is going to be the same. B to C is going to be the same, but the difference is going to be our D completion because we're looking for a different type of pattern. You see, in the butterfly pattern, instead of a 618, we are looking for a retracement with this B leg to the 786, if you can see it in here. So again, what we're doing when we teach traders these patterns is we pretty much give them a checklist, right? And it's like, hey, if we hit the 50%, that is BAT. If we hit the 618, that is Gartley. If we hit the 786, that is butterfly. So although it may be confusing if you're not familiar with them, once you understand the rules, right? And we always harp on rules-based trading, it actually makes it pretty simple. You just look on your checklist, see which one is hit, did it meet the requirement, yes or no, and then you move from there. Now with the butterfly pattern, what I'm looking for is my D completion to be at a 127 Fibonacci inversion. So I'm going to take my Fibonacci extension tool from the high of my A leg right here to the low of my X leg right there. I know it's confusing, I'm sorry, and bring it back up. Let me delete some of the other stuff here. And that butterfly is going to complete right down here at the lower end of that pattern. So we have a few things happening here. We have the smaller Gartley, if you can still see it. I didn't do a good job of measuring out. Looking in here, X to A to B, B to C, C to D, right here at the 127. Or we have the bigger butterfly down there, all depending on how you naturally saw this pattern. Either way, it does give you an opportunity to get involved at the really lows of this silver area. So if you're someone that is trying to play a counter trend move of, hey, silver is holding these lows and I want to establish a position in case we do see that rally, this is going to be a perfect reason to be able to do so. Now, speaking of big moves, we wrapped up last week with some major volatility across the yen pairs as Japan once again appears to have stepped into the currency markets and intervened. But this time they weren't alone. On Friday, the US Treasury reportedly supported the effort by purchasing yen as well, which added more fuel to the flame. Now, if you watched last week's Trading Edge video, you'll remember I said that I didn't think we'd see intervention this soon because fundamentally the market just wasn't really supporting it. But Wednesday's surprisingly negative reaction to the US interest rates seemed to have opened up an unexpected window of opportunity for Japan to act. At least that's my opinion. And here's the important part. It might not be over. With that in mind, keeping on the theme of playing defense, I know it's tempting to see these massive moves and think, man, I can jump on this train and make a real good quick buck. But trust me, and I say this from personal experience, it's a very dangerous game to play, right? Intervention-driven markets don't behave normally. Price can move hundreds of pips in a matter of minutes in either direction. And trying to blindly jump on that bandwagon is much more of a gambler's mentality versus a professional trader's mentality. Personally, I think the smarter move is to just wait until the dust settles, right? There are plenty of other opportunities in the market that you can take advantage of, and there's no reason to put your hard-earned money at risk trying to take a shortcut. Now, if you want more on the history of the yen and how it got into this position in the first place, I did a podcast last week walking you through it. Keep an eye out for that playing defense video that's going to come out either this Tuesday or Wednesday. And if you want more cool trading content, there's no better place than this channel to check it out. All right, I'll see you guys next week. Until then, plan to trade your plan. Take care.